is Don DeBartolo, a senior commodities broker with Daniels Trading in Chicago. I'm the editor of the Trade Spotlight Advisory Service. I want to take a look back at previous trade recommendations to explain the MET formation. MET stands for Momentum Entry Technique. It's an early entry method from the GBE trading methodology. And the title basically explains the concept of this entry method. We're seeking to capture a favorable move on a surge in momentum. So let's take a look at a current position. Over my shoulder, you will see a chart for the July 2012 rough rice futures market. And the trade recommendation was to buy in a breakout above the April 17th high at 1586. But before we entered the trade, we want to make sure that the three criteria are in place for an MET. First, we want to make sure that the direction of the trend is in the direction of the trade. So in order to purchase the futures contract, we want to make sure that the trend is up. And at the time, the U.S. chart company's trend seeker was indeed in an uptrend. Now, if you're not familiar with U.S. chart company or the trend seeker, feel free to give me a call. Secondly, we want to make sure a solid pivot point is in place. There should be a pullback in the market leaving behind that pivot point. So you can see the market traded lower, leaving behind the pivot point at 1586. Third, there shouldn't be another formation on the chart, like a channel formation, which is a consolidation type formation. With a consolidation type formation, there may not be a pivot point. And as you can see, the market was rallying since mid-March. So then on April 23rd, the market broke out and closed higher at 1593. So ideally, we're looking for momentum to carry the market higher to create new highs and closing at new higher prices. A great analogy used by Jim Prince at the U.S. Chart Company is to think of the MET entry method as a mountain climber taking a short break to catch his breath as he continues his ascension up the mountain. That being said, the MET entry method can also be used for short entries. So let's take a look at a past trade recommendation. Over my shoulder, you will see a chart for the June 2012 live cattle futures market. So the trade recommendation was to sell on a breakout of the December 12th low at 119.92.5. Let's make sure the three criteria are in place to use the MET. The trend must be down in order to sell the futures contract, and at the time the U.S. chart company's trend seeker was indeed in a downtrend. Secondly, there was a retracement leaving behind the solid pivot point. As you can see, this time frame was longer than the 1 to 7 days, but it left behind such a solid pivot point. And lastly, there is no other consolidation type formation on this chart. So on March 29th, the market broke out and closed lower at 117.72.5. And you can see in the next trading session, momentum carried the market even lower. On March 30th, the market closed at 116.15. I consider the MET to be an aggressive entry method. The reason being there isn't a close above resistance or below support, which typically signifies confirmation of that breakout. However, if the market rallies with momentum past the breakout price, like you see with the live cattle futures chart, then potentially you won't be able to enter the market back at the breakout price. So if you're interested in future MET trade recommendations, I invite you to follow the Trade Spotlight. Let's work together with momentum on our side. Happy trading.